Welcome to the Mutual Fund Show on NDTV Profit. My name is Alex Matthew, and this show gets you actionable insight that helps you invest better. And that includes advice from experts as well as conversations with the individuals that manage your money. On today's show, we're going to talk first about fixed income strategy and the best way to benefit from a turn in the interest rate cycle that could be imminent. And that includes the role that hybrid mutual funds play in trying to get the best of both worlds, equity as well as fixed income. We'll talk about solution-oriented funds as well, and how to decide if they fit your requirements. We'll talk about several other aspects as well on this conversation. Joining me in the studio for the first time is DP Singh, Deputy Managing Director and Joint Chief Executive Officer, and Rajiv Radhakrishnan, who is the CIO Fixed Income at SBI Mutual Fund. Thank you so much, gentlemen, for taking the time. Absolute pleasure hosting you in the studio for the first time.
Thank you, Alex. Thank you so much.
Thank you.
So let me start with a question, DP sir, to lay the context of where we stand right now. There are several tailwinds, if you can call it that, for an investor into fixed income, yet there are certain challenges in terms of the post-tax nature of it. How would you capture the current moment?
First, the tailwinds regarding the yields, etc. See, we feel that it has peaked, and from here on there will be greener pastures only for the investors. So it's very, very good time to take a call on this thing. Then when we look at it, see, if you look at the inflation numbers, those are becoming moderated, 4.8, 4.9% retail. So this becomes the case that going 3 months, 6 months down the line, we might say some rate cuts, and that will be the time when we can have very good capital gains. So that is one. And second, your question on the taxation part, yes, that is not there at the moment as the things stand today, but that is not the only reason that it doesn't remain attractive, because one reason is then there is a possibility of capital gains, and there's a very, very good probability and possibility of good capital gains. And second, in any case, there's a deferment of tax, even if the tax benefit is not there, because in mutual funds, anything and everything you get in terms of capital gains. One, it is deferred till the time you are there in the market, and it will get triggered only at the time of redemption. And second, there is a possibility of getting it adjusted against any other capital gain of the same nature. So it remains attractive. It will remain attractive for not only HNI, ultra HNIs, but this will remain attractive for the retail investors also for parking their money. Because today mutual funds are playing the role of a quasi bank. It's not only that mutual funds are there only for the equities. The hybrids of each and every category, starting from the conservative hybrid to multi-asset to arbitrage to equity savings and equity hybrids. So there are a number of categories and huge categories. The total number, AUM put together will be almost 4 lakh, 5 lakh crores.
Absolutely.
So that is the play which we need to play, because every individual is busy in his own work. Let this work be left to the expert, left to the mutual funds, and they will take care of it.
So hybrid I will come to in just a bit, but I want to focus first on fixed income, and that's where you come in as well, Rajiv, which is, so DP Singh talked about the tailwinds available as a manager of fixed income funds. What are those tailwinds that you would identify? And there are significant upsides that are potential down the line. Over what period do you see them playing out? That's the tricky question.
Yeah, good question. So when you talk about tailwinds, very clearly a few factors come to my mind immediately. So one is how the whole debate about global policy rates is shaping up. Now, when you look at data over the last few months, it seems to be fairly clear that global policy rates have broadly peaked. You did have the risk that some of the major central banks may have to do additional rate hikes, but today, given that you are more closer to a soft landing than what was perceived a few months back, and data in a way is validating that assumption that inflation is going closer to their targets and growth hasn't completely collapsed. It's still relatively resilient. So the requirement of additional rate hikes probably is not really there from a global policy rate perspective. And that, but again, the core debate that rates are likely to stay at this level for a bit longer, that equation does not necessarily change. So a shift in that global policy rate cycle is definitely positive from our economy as well. And the other, of course, is the potential for a new source of demand to emerge for Indian bonds. And that is where the index inclusion comes in. So we know that JP Morgan has added India to its global bond index. Quite likely that over the next, say, few months or maybe over a period of time, other index providers add India into the various indices. And we are already seeing the impact in terms of flows coming into government securities.
What kind of flows have you seen so far?
Yeah, so far in this calendar year, the FAR securities have got something like 6.2 billion.
Sure.
And on a net basis, GSEC and corporate bonds put together have got something like 5.5 billion. And this is compared to negative flows over the last few years.
Sure.
And as we go closer to the index inclusion, very clearly it's likely that maybe to some extent that might even sync with the global rate cycle also turning. So you could potentially see active flows also coming into our market. So the big story over the next few years would be this added source of demand coming into the government bond market, and that should have a beneficial impact in terms of lower yield over a period of time. But for the very near term, it looks likely that we still need to solve the challenge of higher inflation, higher than target inflation in India. And that's the reason why the RBI is keeping the interbank liquidity fairly tight. But once that phase is over, you will get the benefit of these tailwinds, both from the global perspective and the new demand source that is emerging from offshore flows into our market.
I'll come back to you on the yield curve and also the time frame, which you didn't answer, by the way. I will ask you, DP Singh, about the big event next year, which is obviously the general election. In the run-up to that, generally you see that the government kind of loosens its coffers a little bit, or loosens the purse strings a little bit. Will the domestic borrowing program at all be a factor to watch for a retail investor, or is that something that you shouldn't bother about at all?
I don't think we should bother about that. If you look at the fiscal position of the country and the kind of tax collections which are happening, see, as far as opening the strings of the wallets is concerned, that has already started, right? That is visible and it's continuous. And I don't think it will impact the borrowing big way. I know Rajiv will be a good person to talk in detail about this, but on the face of it, it doesn't look like any big problem coming there.
Fair point. I'll come back to you, therefore, on the yield curve and your expectations. We've seen a very sharp deceleration or a decline in global bond yields, particularly in the US. The expectation that the Fed is done, and the data seems to be supporting that finally. Where does that leave us here in India? We're still not too far away from that 7.3% mark on the 10-year.
Yeah, so the reason why we have not reacted as much to the external drop in yields is very clearly the domestic factors, right? The RBI continues to be very focused on getting inflation back to its midpoint target, which is 4%. Growth in India is relatively resilient compared to the estimates of the central bank, so there is no reason for us to drop our guard immediately on inflation. But why we have not reacted per se in a significant manner is the stance today. So liquidity in the interbank market is fairly tight. So when you look at over the last, say, 3 months or so, our policy rates have not changed. It's at 6.5. But the effective rate that matters on the interbank is 675. Because of tighter liquidity, effectively it's like a de facto rate hike that has actually been done by the central bank. So to the extent that the liquidity dynamics in the market remain tight, and I think that's the reason why we've not really seen a significant down move. The other angle, of course, is inflation, because there are comforting factors also there, because the core inflation number has actually started to decelerate, but headline is the target and that is what matters. And there are a lot of upside pressure which is basically recurring, different items at various points in time, and this is what the RBI is quite worried about. And that in a way is impacting the market as well. So there are some of these factors from a fundamental perspective that are important when you see why our yields have not reacted to that extent. But yes, it's a question of eventually getting that visibility that we go closer to the midpoint, and that I think over a period of time will get reflected.
Would you say 12 months?
I think for this rate cycle to pan out, probably the next 12 to 18 months is when you can potentially see the full benefit of the rate cycle easing. And that again will be in, I would say, coterminous with the flows that will come in, right? Because the index flows will start to come in over the next year. And by that time, we expect that the economic cycle also will warrant lower rates in India.
Is pure fixed income the best way to do this, DP Singh? Or is a conservative hybrid approach or another hybrid approach the best way to do this?
No, see, we are of the strong opinion that not only conservative hybrid is the best approach. You talk about the tailwinds in on the fixed income side, but there are very visible tailwinds in the equity side as well, because a lot of money is flowing into this. If you look at 16,000 crore, 17,000 crore coming through SAP route and backed by FPI money and FI money which has started coming in, and the kind of business numbers, the profit numbers which are coming in, so definitely there we are in for good returns for the investors over a longer period, say 3 to 5 years. So hybrid definitely becomes a good approach. If you leave aside the tax part, the conservative hybrid for the first timers is utmost necessary, because there you don't have the tax benefit of equities or anything. But
which is 25% or less equity.
Yeah, 25% or less, that is there. But the people who are in the lower tax bracket, or if you look at the number of people who are entering the tax compliance area, and the number of the customers who are yet to join the bandwagon of mutual funds, it's in millions, right? For them, the first step can be through conservative hybrid, where they are not bothered too much about the taxation, because this tadka of equity will definitely give them a better return over the period of longer period. If it is not only catching up on the interest rate cycle for a shorter period, because if the people who just want to catch that capital gain, so definitely fixed income. But the people who are long-term investor, it has to be hybrid, starting with conservative hybrid. But of course, you move forward with the multi-asset allocation fund, with 3 years horizon, with the 35% plus in equity category, which includes active equity as well as arbitrage. I think this is the best bet for the people who are having a little risk appetite and having a horizon of 3 years plus. The multi-asset activity, the category is the sweetest spot for any investor. People who are feeling that the equity markets have run up, even for them, because you will get best of both the worlds, best of the equities and best of the other thing. So of course, other categories are definitely there, and we always say, leave the solution of this allocation in between debt and equity at any point of time on the fund managers. Stay, focus
invested
on whatever you are doing,
yeah,
and concentrate on that. Don't spend too much time on this. Just leave it to us. Asset allocation, we will take care.
Okay, fair point. So you're advocating a fill it, shut it, forget it kind of an approach to investing. As a manager, and the opposite side. So as a manager of fixed income, I'm sure that over the past years you've taken umbrage at investors looking at fixed income as a short-term strategy or short-term solution, because ultimately you are investing in paper that goes into several years, so there's no reason why you should not consider it. But the other aspect is, when you mix both equity and debt, the worry is that you're not necessarily taking into account the risk associated with equity. Is that something that you feel more investors should be educated about?
To the extent, yes, because these are products where you have an element of equity exposure. Now, depending on the product range, it could vary. Now, a hybrid, which is equity oriented, has about 65 to 70 always invested in equity, and the debt oriented has 25. So that is something that an investor should be aware of in terms of where the investments are going. But from a manager perspective, it does not really come into the equation, because eventually the debt portfolio and the equity part are managed separately. So how we run it is we have a dedicated equity portfolio manager and a dedicated debt portfolio manager, and within the internal template norms, which basically govern the extent of credit and duration risk that you take in the bond portfolio. I mean, the portfolio manager has sufficient flexibility within that. So I would consider that this is actively managed, very similar to any other pure actively managed debt product. The only leeway, I mean, if I were to compare, unlike some of the pure debt funds where liquidity becomes a very important consideration on the portfolio side, given that that's the nature of investors which are there who require instant liquidity, whereas in most of the hybrid products, the investor base is largely retail, where we typically tend to see that investment horizon is slightly longer. And so the internal portfolio liquidity becomes less of a constraint as compared to a pure debt-oriented institutional product. So that's the only difference. Beyond that, I think it's as actively managed as any other debt portfolio within the internal template norms.
I'm sure. So you speak to investors across a very wide spectrum as the largest mutual fund house, and with perhaps the deepest penetration because of the association of State Bank of India as well. But I'm sure you liaise with the biggest of the big as well, right? So I'm trying to understand how these very large investors are looking at investing through the solutions that you are offering in fixed income. So what is the perspective that they have when they invest? Are they looking more towards the hybrid, or are they continuing to say, look, I don't mind the taxation of fixed income because the benefits are significant?
No, looking at the institutional or corporate client to say so, they are not too much into the hybrids.
Sure.
Because they take separate calls for the equities.
But not institutional necessarily only, just to clarify, but I'm talking about the larger investors in terms of...
No, larger investor, individuals, family offices, they definitely take a very, very big call on the hybrids, because hybrids suits them the best. Because they are the long-term players, they want to lock in money for 3 to 5 years. And as Rajiv said, they get the benefit of illiquidity premium also.
Right.
Because we don't have to keep the portfolio very, very liquid, and there's a illiquidity premium. The pricing is good. So that becomes, and on the pricing side also, especially if I talk about SBI mutual fund, we keep it very dynamic. Just to give you an example, when if we talk about the conservative hybrid fund, so conservative hybrid fund, 25% is in equity, 75% is in debt. Our general policy is that we should not be charging in a regular plan more than 10% of the gross yield on the debt portion.
Right.
And the remaining whatever is regulatory allowed on the equity portion. So on the weighted average side, it comes to around 1.2% as on date. So we are charging, if you look at the competition, the people are charging as high as 2%. So today, okay, the debt yield to market to maturity in the fund is around 6.5%, 7%, 8%, whatever you say. But there was a time when the yields were as low as 4.5%, 5%. So it was criminal to charge 2% on that. That is 30-40%. So we took a call. We reduced the expenses from 2% to 1.1%. So today we are charging with the same formula in the fund, and see that's so that the net return to the investor is good. So we believe in the very, very good responsible investing for the investor, and we are also aware that the hybrid funds, they may be individual investors, retail investors, or large individual investors or family offices. They are putting trust, so the quality of portfolio is always kept in mind.
Fantastic.
So both ways, this is good for them. I mean, best of both the worlds they can have in the hybrid funds.
All right. There's a whole gamut of solutions that are available for an industry that has grown to close to 50 lakh crore of assets under management, DP Singh. But solution-oriented products at this juncture form a relatively small part of that. You as a fund house are talking more and more about this as a product that investors should take very seriously. Why is that?
Because, see, anybody is having surplus money. As we have long-term goals, short-term goals, medium-term goals. So for long-term goals, see basically there are two, when we talk about solution, there are two parts. One is solution-oriented funds as categorized by SEBI,
Yeah.
and one is knitting solutions within the existing open-ended funds. So first I will talk about the categorization. So I think with the kind of in the solution category there are two. One is children benefit fund, one is the retirement benefit. There are two categories which are available. As far as children fund is concerned, most of the times the time period for the horizon of the investment is quite longer.
Yes.
Which is say 10 to 15 years or even longer than that, because you can put money only up to 18 years of age, but can continue till the time it is required by the customer. So when fund manager knows about this, that the investment horizon is quite
That
big,
long, yeah.
so he can take a very logical long-term calls on the portfolio also. So that there's no liquidity pressure, there's no redemption pressure. So he can look into the companies which are going to give very good returns over a longer period. And India being just starting, being the manufacturing hub, there are so many new businesses which are coming. And generally, I've seen, this is not a rule or this is not something condition, but fund managers are taking long-term calls, they're putting money in those companies, small companies, which are available at a very good valuation, which can create very good value over the longer period. So that's one part, and then you can create very good wealth for the people for capital creation. We don't say that this is for investor, this is education of child or see marriage of daughter or marriage of the child.
You don't label
that.
it.
We want that this can be anything.
Sure.
When children grow up, they have to follow their passion. Somebody will like to be an astronaut, or somebody will like to be a sports person, somebody will like to go to theater, somebody will. So everything needs money. And even if you want to start up your own business, so there's some capital requirement.
Fantastic.
The parents don't have to get a dip into their own capital in their businesses and do it.
Right.
So creation of capital is very important, and we have seen the funds generally have given very good returns. So, but there are less numbers of buyers at this point of time. Our fund, which has grown 3 times in 3 years, has a corpus of just 1,500 crore rupees.
Okay.
But the idea is not to push it, let people understand that the fund managers are doing a great job for creating wealth for their customer. Now the second category is the retirement benefit. Obvious reason the people need to accumulate money, which can create wealth, which can take care of, because of the longevity being much longer than ever before.
Right.
So that there's a requirement of that through the SWP route, and then this SWP is a solution knitting. This is
Right.
not category. So then when we come to the solution knitting, so there are a number of funds, a number of solutions depending upon individual needs. We can have so many solution knitted. So financial advisors, they can definitely help the investors in doing that.
So-
and in mutual fund that is possible.
So there's a solution for everybody. That's the idea. Gentlemen, I think we've had a fantastic conversation. Thank you so much for joining us in the studio, and pleasure having you. We look forward to the next meeting.
Sure.
Thank you so much. Thank you,
All right,
Alex.
and there you go, viewers. We've had quite a holistic conversation, focused primarily, of course, on fixed income and hybrid. Let us know what you think in the comment section on our various social media platforms, or in fact, you can write to us as well. It's been a pleasure bringing you this show. Do stay tuned. Lots more coming up over the course of the day. This is NDTV Profit.